Pioneer Foods posted annual results today that saw revenue growth growing by 10%, headline earnings per share increasing by 4.8%. The dividend, though, went up by 42% to R1.14. Now, despite the solid numbers, the share price has reached the top end of the range many analysts were expecting. Now, here to discuss Pioneer's valuations and other picks in his hedge fund, Anthony Durham from Cogito Capital. Anthony, thanks so much for joining us today. So what are your thoughts? Let's start off with Pioneer Foods. You're shorting the stock. Give us the reason behind that.
Well, what we've done is we've bought Zeda and we've shorted Pioneer, which is the kind of the majority of the valuation in Zeda. And so essentially we're playing the rump of Zeda. We think Pioneer is expensive at the moment. We think it's fundamentally a good company, but pricey in terms of the fact that its margins are under a lot of pressure. So we think that when the input costs normalize, margins will widen and profitability will recover. But until that time, we would be happy to hedge out of our exposure to Pioneer through our Zeda holding.
It was interesting just looking at one of the analyst valuation that came through today and looking at the sensitivity of the company to percentage changes in the margin. And that, of course, is something you're highlighting.
Yeah, I mean, I think 2/3 of the operating profit comes from Sasco, which is a milling business, primarily produces bread. Wheat prices are at record highs at the moment. Until they normalize, as I said, margins are going to be under pressure.
Anthony, you talk about the rump in Zeda. What is the rump?
The rump, okay, so there's Cape Span, there is Chaitin, which is a farming operation in Zambia. There's Agricol. So some great little businesses that are trading at a substantial discount to their look-through value. You can get them at the intrinsic discount to the intrinsic value, at a discount to their look-through value. I think we value Zeda at about R3.35. It's trading at R2.86, so you're getting it at about a 60% discount, 16% discount. But the overall theme we like. We think that 60% of the world's 6% of agricultural land lying fallow is in Africa. And we think that Zeda is probably the best way, lowest risk way with greatest potential upside to play the idea that more people are going to eat in the world, and Africa at the margin is going to be the supplier of additional food.
That being said, let's talk about why it is trading at this discount right now, and your views on making money in the agricultural space, given all the unknown and unforeseen events when it comes to weather and, of course, prices in the food sector.
Yeah, so we think that you're getting a nice diversified portfolio by buying Zeda, but we think that the best way to play this agricultural theme is to buy Omnia, which is the second biggest holding in our fund. We think that we'd much rather buy a fertilizer producer and distributor that is kind of diversified away from regional climate differences, regional kind of issues around owning farmland, for example, in Zimbabwe. We think that it's kind of low risk way with lots of upside to play the idea that lots more maize and sugar is going to be planted in Africa, and certainly in the sub-region. We're very excited about what's going on in southern Mozambique with TSB. We think the best way to play that is through Omnia. We think that the record maize price is going to lead to a big increase in plantings this season. The margins that farmers are making are fantastic. So every available square meter or square acre or square meter is going to be put to maize. And we think that marginal land is going to require a lot more fertilizer. On top of that, you've got the benefit of this nitric acid plant that Omnia's put in. It came in under cost and on time. And we think that it should produce massive cost savings and widening margins for Omnia. The results are tomorrow, so it'll be very interesting to see how the results will come through.
Anthony, these are big trends, and Sam's alluded to some of the problems that farmers and agricultural producers face in terms of variability of weather patterns, all sorts of different variables in input prices as well. What you're talking about are fairly macro themes, and will, I imagine, take a long time to blossom, if I could pardon the pun. Is this something that you're going to hold for? How long do you anticipate holding some of these shares to see the fruits of investing in this theme coming off?
When I buy a share, I buy it with the view to never selling it. I think that that's a strong discipline. If it gets insanely expensive, we'll look to take some value off or lock some value in. But I think the long-term themes around Omnia are fantastic. We think that the management are executing on their strategy very well. Not only does it give you exposure to farming, but also to mining in Africa. We think the other big theme is increasing volumes. I don't know where prices are going to go, but I know in Africa, mining volumes are going to increase. We think the lowest risk way with the greatest potential upside is to buy an explosives business, which Omnia is. I think about 40% of their operating profit comes from the explosives business.
And what about Sasol? I mean, if you're talking about kind of, that part of the business, Sasol, you also get exposure to that. Would you rather have a niche player like Omnia as opposed to a diversified Sasol? And diversified, I mean, it's got, of course, many moving parts.
Sure, we own Sasol as well. But we think that the fertilizer element to it, although it's, it's a very low-cost fertilizer producer, it's a very small part of the overall proposition. So we think if a more focused way to play this fertilizer stroke explosives theme is through Omnia. It's also an attractive valuation, trading at about 11 times earnings on an annualized basis. We think that there's real opportunity for them to increase the dividend. The debt equity ratio is around about 19%. So we think that this thing could become a great cash cow and get re-rated as a result of an increased dividend or decreased dividend cover.
Anthony, you've noted, we note here that Kumba Iron Ore is another company you've been shorting, and it's also one that investors, I know of other fund managers that have been wanting to get exposure to the rump of Anglos. Where does Kumba fit in relation to Anglos, and are you playing that paired trade where you offsetting the value of the one company with exposure to the other?
Absolutely. We're buying the rump of Anglo, essentially, by stripping out Kumba.
And when we talk the rump of Anglos, what exactly are we referring to there?
Okay, so it's all the other assets other than Kumba. So it's Amplats, it's the coal assets, it's De Beers, it's the copper assets, it's, all the other assets in Anglo other than Kumba, Amplats. So, we also own Exxaro. And again, so this is a hedge to our Exxaro position. So between Exxaro and Anglo, we've got quite a big exposure to Kumba. We think Kumba is expensive, so we've shorted Kumba against Anglo and Exxaro.
We have seen Exxaro underperforming recently, and its concerns around the mineral sands business there. And I suppose we have seen margins come back for the iron ore traders, iron ore companies. What are your thoughts on the difference between Exxaro and Kumba's performance recently?
Well, obviously it's Tronox. This is the mineral sands business. Their utilization rates are down on last year, as are prices. But I think that the long-term prospects for titanium dioxide are quite good. Titanium dioxide is used in pigments, specifically white paints and ceramics. And if you like the idea of a pickup in building activity in the US, in China, and one day in Europe, I think this is a great way to play it.
So you think the market has kind of treated this stock unfairly and kind of a short-term view right now as opposed to your longer term?
We've been buying more Exxaro at the 157 odd level. We think that the coal business is fantastic. We think that production in critical liquor is going to double as the Kusile and Medupi ramp up. I think it's a good story, good long-term story. We think the rand's going to weaken, so that's one of the reasons why we bought the stock as well. We think that as the terms of trade for South Africa deteriorates, the likelihood of a rand weakening even further increases. We do not have much exposure to importers. We've got a lot of exposure to exporters, and that's where we'd like to be positioned.
This story about the balance of payments in South Africa's balance of payments now a negative 6.2%, so a current account deficit, is quite a big theme amongst many investment managers, and a lot of people have been saying the rand is highly vulnerable at this point because of, one, the balance of payments deficit, and two, the composition of the investors in the bond market, which are typically foreigners who are prone to changing sentiment very quickly. What's your view on further catalysts for the rand to depreciate? I mean, we had a very tough time with Marikana, and we did see the rand touch 9 to the dollar. How much worse can it get?
Well, I think the rand is very susceptible to so-called black swan events anywhere around the world. Any emerging market black swan event could cause the rand to weaken, and then it becomes a self-fulfilling prophecy or spiral. The more the rand weakens, the higher interest rates go, the higher the likelihood of interest rate increases here, the more likelihood of the rand weakening or in foreign investors pulling out. So I think that the probability of one event is small, but the collective probability of the sum of all events out there is quite high. So we would think any type of kind of macro event could cause the rand to start weakening, and then for it to kind of, from an arithmetic progression, to get to a geometric progression through a tipping point, and you could see the rand weaken quite quickly. We think, past 10 rand to the dollar.
Mm-hmm. Let's get back to some of these stock selections that you have right now, because it's interesting. We're talking about Zeda, and then let's talk about PSG. Yeah, not so bullish on PSG as you are on Zeda. Why is that?
Well, we think that on a sum of the parts valuation, a lot of that value is derived from their listed investments in Coro and Capitec.
Mm-hmm.
We think Coro, although it's a good story, is massively overvalued relative to its potential. As we think, again, the rand is very vulnerable to some kind of macro event. We think so are LSM 1 to 7 borrowers in the Capitec book are also very vulnerable to a weaker rand. A lot of them commute to work by taxi, and I think the number is about 40% of the average LSM 1 to 7 employee spends 40% on their salary. 40% of their salary on transport. So if the rand weakens, we think that transport costs could go up even further, and we think that this massive increase in unsecured lending could result in an increase in non-performing loans and obviously big write-offs and a fall off in the share price of Capitec.
So it's basically some of the parts right now, looking at that valuation and saying it's just a bit expensive for what you're seeing into the future right now.
Absolutely.
Yeah.
Just in terms of the other banks, we've mentioned Capitec, but I see that you hold Investec PLC shares. What's the reason for that particular holding?
Well, we think Investec is ridiculously cheap. First National Bank trades on 2.5 times price to book, Standard Bank 2 times, Nedbank 1.9 times, Investec 1 times. So it's cheap. If you like the idea that the UK economy will eventually turn, the property market specifically, and we're already seeing London property prices pick up. A lot of people like property as an investment class. Investec's a great way to play London, Irish, Australian property. As non-performing loans get written back, or the provisions for those loans get written back, you'll start to see a pickup in profitability. As you see capital markets recover, again, profitability will recover. I think the asset management business is fantastic. They've got a great brand, great distribution, good performance in general, and we think that's a very valuable franchise that's been built. And we just think that the market's not giving Investec recognition for the intrinsic value in the business.
And then lastly, you mentioned your second largest holding is Omnia. So what's your first largest?
Our largest holding is a company called Amalgamated Appliances. We think this is the best way to play the increase in cash consumption in Africa. So 11% of AMAP's business comes from Africa. They operate in 15 African countries. And their strategy is really to follow their big mass retailer clients into Africa, Massmart, Pick n Pay, Clicks, ShopRite, selling the Russell Hobbs appliance, Sultan, Pineware, various sewing machines. We think this is ridiculously cheap. It's trading
on a cautionary right now.
Yeah, share price is up 7% today. So yeah, we think that it trades on about 10 times earnings. We think it'll do about 38 cents for the next 12 months, valued at probably about 12 times earnings, $4.25 target price will give you about 30% upside from here. So it's a good story, low risk way to play the increase in African consumption.